Hi, Gabriel Josiah here. Have you ever wondered how quickly businesses turn sales into cash? What if I told you there's a critical metric that could make or break cash flow, impact growth, and even affect how creditors see the business? In this video, we're diving into receivable collection period, which is also known as days sales outstanding. A powerful financial tool that helps businesses track how fast customers are paying up. Stick with me as I break it down step by step with the graphical scenario and example and show you why mastering this could be the key to unlocking smoother operations and a healthier bottom line. Let's dive in as I share my screen as is our custom. And let's look at graphically a perfect description of the receivables collection period or the days sales outstanding as is popularly known. This is a financial metric that measures the average number of days it takes for a company to collect payment from its customers after its sales have been made. So typically you have two types of sales that generates or culminates into revenue. Number one, you have cash sales and you have credit sales. Actually, both based on IFRS 15 can be recognized immediately. Performance of the obligation has been transferred to the consumer or the client. So you could recognize revenue immediately. But cash sales does not need any collection period. But credit sales does. And credit sales is essential for businesses to expand their tentacles, add more to their sales, because there are some customers that like some rebates based on time, amount, and other credit terms for them to be able to get more revenue as a company. So credit sales is or are essential for businesses. Is crucial, or the ratio is crucial because it assesses a company's efficiency in managing its account receivables and also its cash flows. So this ratio helps us track or assess how a company efficiently or effectively manages debtors or accounts receivable and its cash flow for day-to-day operations. The formula is clear. It has to do with average accounts receivable, which is your beginning and the ending divided by 2. So you have the beginning period at the start of the year and at the end of the year, and you get the average, which is divided by 2. And you have only the credit sales as the denominator expressed as a year, which is 365 or 366 days, depending on the year. If you have it 366 days, then it's a leap year. Right, so this formula is simple, but let's graphically describe it by calculating the ratio with this formula practically. So we've been using Shalbutu Nigerian PLC to buttress most of our calculations. Okay, so from the question here on the screen, you could see that the trade receivables for the beginning of the year 2020, we have it as 400 million, and for the end of the year, we have it as 470 million, which shows the receivables have increased by 70 million throughout the 12 months period. Okay, so if you have a calculator, just follow me. I will use Excel here to calculate it. Okay, so for the calculation, now we have it as trade receivables, the beginning and the closing. So let me have this as my opening. Let's cut this, post it here as my or our closing. It's simple to navigate and calculate. Okay, so we have the opening, which is 400 million. We have the closing, which is 470 million. So let's have the total. Let's sum it up, and we have 870 million. Now let's have the average receivables. Don't forget, the average receivables is calculated by your opening and closing divided by 2. And if it's for 3 years, we divide it by 3. So to get the average, and the average receivables is 435 million naira. Very simple. Okay, so let's have our denominator from the question, which is in the statement of comprehensive income, and we have it as the sales revenue of 1.2 billion. So take note of a caveat or a note, which is number 3. And it states that of the total revenue yearly, 75% was cash, while the balance was credit sales. So the question is, what is the balance? Balance, of course, is 25%, which is credit sales. So of this 1.2 billion naira generated as revenue, 25% based on this note is on credit. So take note of that. 25% is on credit. So let's go and calculate based on that valid and vital information. So we have our sales revenue, which is 1.2 billion. Now we have our credit sales, which is 25% of the total amount. So it's simple. We just have this, our total credit sales times 0.25, which is the same thing as 25%. And we have it as 300 million naira. So invariably, 75% of this 1.2 billion naira is 900 million naira. Simple. So cash sales is 900 million. My credit sales is 300 million. The total is 1.2 billion. Okay, so let's go back to our calculation. Let's have our receivables collection period, which is expressed as our average receivables divided by our credit sales times 365 days. It's simple. And we have 529 days. Wow. A whopping 529 days to recoup on average back the receivables. That is quite high. Really, really high. Okay, so how many months, let's see, does it take to recoup the receivables back or turn them back into cash? So I just say the days divided by, let's say, an average 30 days in a month. And we have it as 17.6 months, which is 17 months with some days, but 6 days. Wow, that's quite high. Okay, let's see how many years it will take to recoup back the amount. So just say this number of days divided by, on average, we have 365 days in a year, except if it's a leap year. Have just 1 year, 4 to 5 months. Wow, that is quite high, or a longer or a higher receivable collection days for this company. Okay, but we're taking days. The days are very essential for our calculation. I just broke it down for you to have a grasp of what it looks like or how long it took for this company to recoup back their receivables for the year 2020. Okay, let's see what this means. What does this mean? Means the receivable collection period is how quickly a company converts its accounts receivables or its debtors into cash. That's simply what it means. And a shorter collection period suggests that the company is effective in collecting payments from customers. And a longer one indicates issues with credit policies or customer payment behavior, like we just saw in this example, a scenario we graphically calculated just a while ago. Now, the implication is that a lower receivable collection period is generally favorable, shorter in days. In fact, some industries advocate 30 days max, 60 days maximum, 45 days maximum. It also reflects strong cash flow management and effective collection policies. And this is for lower collection period. Now, for higher ones, it signals potential cash flow problems and inefficiencies in collection processes, which can adversely affect the company's financial stability in the short run. And the working capital management, which has to do with the current asset less current liabilities, is what is used to run the company on a day-to-day basis. And when you have longer receivable period, which is one of the components of your current assets, the current assets is going to cause financial destabilization for the organization. Take note of that. So what is the cause and effect? Let's start with the short receivable collection period. The causes are effective credit management. So where you have effective credit management, the collection periods will be short. Prompt invoicing of customers, strong customer relationship, effective collection strategies. This culminates in shorter receivables collection period. While the effect is that it improves cash flow, your day-to-day business moves or is enhanced seamlessly. It also enhances liquidity and reduces the risk of bad debts. The funds going bad, it reduces that risk drastically. Now, the longer receivable collection period is caused by lenient credit policy, or some companies don't even have credit policies. They just give credit like that. So causes are slow credit payments practices or ineffective collection efforts. These are the causes of long or longer receivable collection period. While the effects is, it shows in the cash flow constraints, increased risk of bad debts, and potential negative impact on operational funding, especially in the short run. These are the effects. So in conclusion, the receivable collection period is vital for accessing company or business's effectiveness in managing its accounts receivables and cash flow. So businesses need to monitor this ratio, this metric, to identify areas of improvement in their collection processes to help optimize cost flow and enhance overall financial health of the business. This is very, very important. And businesses should take note of that. And as accountants, we need to help businesses track this metric to help enhance cash flows. All right, and there you have it. Now you know how to calculate the receivable collection period or the days sales outstanding, and how it plays a crucial role in managing a business's cash flow. Remember, understanding this metric helps you not only track how quickly customers are paying, but also gives you insight into improving liquidity and staying ahead of any cash flow challenges. It's a proactive way of understanding and tracking receivables. Okay, if you find this helpful, don't forget to like, share, and subscribe. Also hit the notification bell so you won't miss any upcoming videos on simplifying financial management for your studies, for your exams, and for practical application. Also drop your questions and thoughts in the comment section. I would love to hear how you're applying this to business, how you're calculating it, especially with the graphical scenario, case scenario I presented. Until next time, keep those connections flowing. Until then, bye for now.